when you look at the stocks and when you look at the companies rather that make up the Dow? Is it really emblematic of where the nation is economically right now, where people are with their personal finances, who are individual investors? What about all the above? And more importantly, I think, why are less Americans today taking advantage of this and reaping the benefits than just 10 years ago? We've gone from 65% of Americans in the stock market in 2007, then came the Great Recession, and now that number is down to 52%, and yet we've seen it go way up to the 20,000 mark, at least in the Dow. Let's talk to Kyle Walters this morning about a financial strategist. Kyle, good morning.
Good morning.
So why aren't more Americans in right now? Are they still skitterish after all of the, the travails of 2008, 2009, 2010, or is it just a case of, they're just slow to trickle back because it's a low number when you look over the last 25, 30 years?
Mm-hmm. Yeah, that's a great question. And, obviously everybody's got their own story. What we see is people when they, when the markets go down, sometimes they say, well, I can't take anymore, I need to get out. And there's no plan on how to get back in. And that's the challenge, really, when you're trying to time the market in and out. And why it's extremely difficult to do, and pretty much nobody can do it, is you have to be right twice, when you get out and when you get back in. And that's really what you're seeing, the numbers heading down as far as when people own stocks. So, you've got a bunch of people that can really just be on a set it and forget it plan in their retirement and just say, hey, I know what works for me over the long term. But unfortunately, the statements come in every month and every corner, and that volatility scares a lot of people.
This is what and I've talked about this with other financial advisors. This is what I call the ones that come in with the quarterlies, where you just look at it and then you don't open it and you just put it in the drawer and just just let it kind of ferment there, because it's going to be bad. You don't want to see the numbers in parentheses, but you don't look at it because it's going to make you want to push the panic button. And some people do that. Is there a certain is there a certain plus to not looking at those quarterlies when things are going rough?
Yeah, I mean, there's always the striking the balance between, hey, I want to be an educated investor, but at the same time, the more educated you become, the more you realize that as people and as emotional people, we are our own worst enemy when it comes to successful investing. So we kind of say, okay, if nothing has changed with my goals, why should anything change with my portfolio? I set this up a certain way for a certain reason. If that reason has changed, maybe I can go live my life and say, hey, if I open this statement once every year or whatever it might be, my portfolio is going to look a lot less volatile, and it's going to stress me out less, and I'm going to end up in the same place.
No, I hear exactly what you're saying. What about the figure 20,000 in and of itself? Do you consider that a real benchmark, or is it more? These days, is it more psychological than anything else?
Yeah, I mean, I think it's psychological for a couple of reasons. One, really what you're talking about is the price of an index, right? So, this is 30 stocks.
30.
Well, in the global, 30. So in the market, in the global market, there's thousands of stocks. And, with most individuals, they're invested kind of, U.S., all over the world.
Diversified.
In bonds.
Yeah, diversified, right.
They're diversified. Yeah, so 30 stocks has a really kind of a marginal impact on this. Now, that being said, the Dow 20,000, right, for people, right, they start to anchor on certain pricing, and psychologically it affects people. So the biggest thing is to go back and say, okay, nothing's changed with my goals. Nothing should probably change with my plan.
And how often do you think people will do that, or is this where folks start to make a mistake?
Typically when the numbers start to get, the more coverage the markets start to get, people start to make knee-jerk reactions. Because, if you're seeing things in the newspaper and you're seeing things on CNBC or the channels and people are talking, naturally investors just say, well, everybody's talking about this. I feel like I just need to do something. And a lot of times something is the wrong thing to do. You gotta decipher, am I being a short-term speculator and just guessing with other guessers, or am I saying I'm going to be a long-term investor and take advantage of, if there's volatility in the markets and I'm dollar cost averaging and investing on a systematic basis, I can actually take advantage of downturns.
What are you telling people? I mean, I'm not asking you to pick individual stocks, but what do you like at the 20,000 mark? Since we've just hit that 20,000, I think 68 points before opening today, before the bell rings. What are you what are you looking at right now yourself? What are you excited about? What are you looking at more for your clients here in the near future?
Yeah, I mean, I think what we're always trying to do is we're always trying to keep people from being their own worst enemy. So, when we talk about biases that we know individuals have when they're looking at their own portfolios, we try to educate ahead of time and say, look, here's what we can expect in any type of portfolio, and talk about worst-case scenarios. So that way when it happens, it's not a big deal, and if we hit another 2008, we can look at that as an environment to maybe take advantage of rather than run from.
And do you anticipate we'll have another 2008 at some point here? And if so, how soon? That's what people want to know.
That's what people want. Hey, this is what to always remember, and this is what I say: just go back to the most common sense you can think of. And here's the deal: if I knew when 2008 was coming, right, and if I knew that answer, I wouldn't want to tell anybody, because the way the stock market works, if you got the inside track, tell everybody. The inside track goes away. So the deal is, whoever knows is on a private island and is not taking calls. And history tells us that no one is really good at making that call on a consistent basis. So you really just got to, the downside is, but here's the deal. When they talk about roller coaster, the person that gets hurt on a roller coaster is the one that jumps off before the ride is over. So there's going to be ups, there's going to be downs. Like you said, don't pay too much attention to the statement, because you're not going to be selling everything tomorrow. So it's almost just for your information.
Kyle Walters here. Real quick before we let you go, next segment here, we're going to be talking about service on student loan debt. Growing. Do you have concerns about that with our overall economy over the next 10, 20 years?
I don't know how it's going to affect the overall economy. I do think it's a huge burden for kids who are getting an education and trying to further their education to come out and be saddled with that much debt. So I think it's an issue, and have no idea how to solve it.
Yeah, that's well said. You're an honest man. Kyle Walters here, financial analyst. We're talking about the Dow, 20,000 point. Kyle, what's your website?
AtlasWealthAdvisors.com.
All right, ATLAS, Atlas Wealth Advisors. Kyle, thanks for joining us very much.
You got it.